A lot of people think hitting $1 million in their 401k is the finish line, the green light to finally retire. But here is the truth. That number can be a dangerous illusion. I've seen it too many times. Retirees who cross that $1 million mark only to realize a 401k does not give you a paycheck. Instead, you're facing taxes you didn't account for, withdrawal rules you don't understand, and risks that can shrink that balance faster than you'd imagine. Suddenly, $1 million doesn't feel like $1 million anymore. If we haven't met yet, I'm Rosanna Quinnan, a chartered financial analyst and founder at QuinVest, where we help successful professionals and business owners plan for and enjoy a long, happy, and secure retirement. Over the years, I've walked alongside dozens of families in this exact situation. Smart, hardworking people who thought they'd done everything right. But no one ever told them the full story. It's not about how much you've saved. It's about how you turn those savings into reliable income without making costly mistakes. That's why in this video, I'm breaking down 5 things you need to know before you touch your 401k. Miss even one of those, and that $1 million balance may not last nearly as long as you think. Let's dive into the first mistake, and it's the one that even the savviest retirees rarely see coming. The most overlooked threat in retirement: taxes. That $1 million sitting in your 401k, it's not all yours. The IRS has a claim on it, and it could be 25, 30, and even 35% depending on your state and income tax bracket. Your 401k was never tax-free. It was tax-deferred. Every dollar you withdraw is treated as ordinary income. And if you're not careful, those withdrawals could push you into a higher tax bracket, trigger penalties, or even impact your Medicare premiums. I've seen retirees who thought they were set, and yet they might only keep $700,000 or even less after taxes. It feels like a gut punch. You did everything right. You saved, you invested, you followed the rules. But now you're getting hit with tax bills no one prepared you for. And there are 3 powerful strategies to fix this. First is the Roth conversions. Convert portions of your 401k to a Roth IRA before the required minimum distributions age. Do it when your income is lower to reduce future taxes and allow tax-free withdrawals later. The second strategy to reduce your taxes is the qualified charitable distributions. When you hit 7.5, you can donate directly from your IRA to a charity and do it tax-free. It satisfies your required minimum distributions, or RMDs, and lowers your taxable income. And the third strategy is withdrawal sequencing. Instead of tapping your 401k first, draw from your taxable brokerage accounts early on. That lets your 401k grow longer and delays big tax bills. It's not about avoiding taxes, it's about avoiding surprise taxes and turning your retirement into something predictable and not stressful. But tax isn't the silent threat. Because even if you avoid the IRS, there is another gap that could wreck your plans. The day you retire is the day your paycheck disappears. And that's when a massive shift happens, financially and emotionally. Suddenly, you're no longer adding to your 401k, you're taking from it. Every dollar that comes in, it's coming out of your savings. That might not sound scary until you realize there is no direct deposit showing up every 2 weeks in your checking account to replenish that account. So you become your employer. You're the employer now. Your retirement accounts have become your salary. And most people aren't ready for that shift and what that really feels like. It's unsettling and it's disorienting and creates a constant background noise of financial anxiety. Because a 401k is just a lump sum, not a paycheck, it doesn't tell you how much you can safely spend, when you should withdraw, and how long it will last. I work with families who had $1 million saved and were still that terrified to spend more than $3,000 a month because they had no idea if their money would last. This uncertainty leads to 2 extremes: overspending and running out early, or underspending and living in unnecessary fear. The good news? There's ways to fix it. You need a solid retirement income plan, one that gives you clarity, structure, and confidence. Here is what it looks like. A, establish your baseline budget. Know exactly how much you need each month to cover your lifestyle. B, layer your income sources. Use guaranteed income first, like Social Security or pensions. Then build your retirement paycheck from your savings to fill the gap. And C, match withdrawals to tax efficiency. Coordinate withdrawals from your 401k, IRAs, and other accounts to minimize taxes and keep your income sustainable. With a proper income plan, you don't just guess what you can afford, you know. And that's what turns a retirement number into real confidence. Now, before we go any further, I know looking at $1 million 401k can feel overwhelming. You might be wondering, does this apply to me? Am I really on track? Or are there risks I don't see yet? And that's exactly why we offer a complimentary retirement readiness call. In this call, we'll talk through your situation, uncover hidden risks that could shrink your nest egg, and give you clarity on what to watch out for. Just click the first link in the description to book your complimentary call. Spots do fill quickly, so don't wait. All right, now that you know how to build your own paycheck in retirement, let's talk about the one risk that changes the entire equation. Because it's not about how much money you start with, it's about how long that money needs to last. And here is something most people don't think about. Your biggest risk in retirement might not be the stock market or taxes, it's longevity. Living too long has quietly become one of the biggest financial challenges of our time. Retirement used to last 10 or 15 years. Today, it can last 25, 30, and even 40 years. And that's a whole second lifetime. And if your plan isn't built for that, even $1 million can run dry. Every extra year means another year of withdrawals, another year of inflation, and another year of rising healthcare costs. So the question isn't just, do I have enough to retire? It's, do I have enough to stay retired? And there are 3 ways to make your money last longer. First is build layered income for life. Think of your income in layers. Start with guaranteed sources like Social Security and pensions, and then add predictable income from investments or annuities. Because the goal here is simple. You want to create paycheck that will last as long as you do. The second thing you should do is plan for inflation and rising costs. Your expenses in year 1 will look nothing like year 20. In fact, your expenses will about double in about 25 years. Keep part of your portfolio invested for long term so your future self can afford the same lifestyle your present self enjoys. And stress test for longevity scenarios. Most people have never actually seen their entire financial life mapped out in one clear picture. And that's exactly what brings clarity and confidence. When you see your income, spending, and assets projected over time, you'll know whether your plan holds up to age 95 or even 100. And if it does, that's real peace of mind. So even if you plan for taxes, build a reliable paycheck, and stretch your money for decades, one thing that can still derail it all, the markets. When volatility hits at the wrong time, it's not just numbers on a screen. It's your lifestyle on the line. So let's talk about that next. Before retirement, market dips weren't frustrating. Well, they were frustrating, but recoverable. You had time, you were still earning, and you could keep contributing. In retirement, everything flips. Instead of buying during the dips, you're selling, pulling money out of your investments to live on. And if the market's down and you do that, you lock in those losses forever. This is called sequence of returns risk, and it is one of the biggest threats to retirees who leave their 401ks fully exposed to the market. If you experience a downturn early in retirement and you're withdrawing at the same time, your account can shrink faster than expected, and you may never recover. There are 3 ways to protect your income. First is to segment investments by time horizon. Keep 1 or 2 years of expenses in cash or conservative assets. And then midterm needs in income-producing assets. And lastly, long-term growth in equities. Use a bucket strategy or guardrails. Set clear withdrawal rules based on market performance to prevent emotional decisions and keep your plan sustainable. Stress test your plan. Run the numbers. Or work with an advisor to see what happens if there is a 20% drop early in retirement. But even if you avoid taxes, plan your income, stretch your money, and manage risk, there is still one huge mistake that keeps people stuck in the wrong system. A lot of retirees leave their 401k exactly where it's been, at their former employer. It feels easy, familiar, and safe, but that convenience can come at a steep cost. Most 401k plans are designed for accumulation, not distribution. They're built for saving and not spending. And when it's time to turn your balance into income, they often fall short. You're using the wrong tool for the job. Rolling your 401k into an IRA is one of the most important moves you can make in retirement. And here is why. You will have more control over your investment. You're no longer limited to the 10 or 15 choices your employer picked years ago. You can build a portfolio that matches your risk, your income, and your tax goals. Flexible withdrawal strategies. IRAs allow you to coordinate distributions with other income sources to manage taxes and avoid costly mistakes. Better integration into your retirement plan. An IRA fits seamlessly into broader retirement strategy alongside Social Security, pensions, and Roth accounts. So if you've been thinking, well, I've got a solid balance in my 401k, over $1 million saved, I should be fine. I hope this video helped you see why that's not the whole picture. And now that you know why $1 million 401k doesn't automatically mean you're ready to retire, you should look at your situation more carefully. Your situation deserves more than generic advice. If you're still unsure or you just want a second set of eyes on your plan, now is the time to take action. Click the first link in the description and schedule your complimentary retirement readiness call. When you call, we'll talk through your balance, your goals, and the risks that could trip you up so you can move forward with confidence. Thanks for watching. I'll see you in the next video.